The market keeps chasing whatever AI headline feels lit, hyped, and ready to pop off overnight. But real money rarely moves where the crowd is screaming the loudest. Sometimes it moves where nobody's looking, low-key, quiet, almost ignored. Right now, this penny stock is sitting around $2.02, and that's where things get interesting. Because if it clears $3, then $4 becomes the next wave, and $5.50 turns into the victory lap for the early squad. Here's the real question. What if one of the most overlooked AI infrastructure plays today isn't flashy at all, but deeply embedded? What if the upside isn't hype-driven noise, but revenue already flowing and contracts already signed? This isn't about chasing what's fire on social media. This is about spotting what's next before Wall Street catches on. And lately, earnings transcripts, platform metrics, and research notes across Yahoo Finance, Seeking Alpha, and Bloomberg terminals suggest something quietly powerful is forming. Today's breakdown is about mispricing, not rumors, not hope. We're looking at a company trading at a fraction of what its platform scale implies. Market cap under $1 billion. Stock action flat. Ignored. Barely talked about on MarketWatch headlines. Classic behavior for overlooked small cap stocks. But under the hood? Revenue stability, improving margins, a balance sheet that looks healthier than most peers at this size. This is where quiet money moves happen, especially in micro-cap stocks before sentiment flips. Short-term traders chase candles. Long-term investors study systems. Emotional money reacts to headlines. Data-driven capital reads SEC filings, earnings calls, and cash flow statements. The same ones analysts on Bloomberg and Yahoo Finance dissect every quarter as part of serious fundamental analysis. The real risk isn't volatility. The real risk is missing asymmetric setups while waiting for confirmation that arrives too late. Big brain approach, data first, probability second, emotion last. Because when re-ratings happen, they don't ask permission. Before we jump in, welcome to KMI, delivering sharp data-driven insights on emerging tech and high-potential U.S. market opportunities. Designed to help you spot the next big winner. Subscribing simply keeps you plugged into this long-term, logic-first way of thinking. Now let's talk about the company. The company is Tuya, trading on the NYSE under ticker TUYA, currently sitting around $2.25. Tuya operates as a global IoT and cloud platform powering smart devices worldwide. Think infrastructure, not gadgets. They don't sell hardware. They enable entire ecosystems. Their customers are device manufacturers, brands, and developers, lighting systems, energy controls, security devices, appliances, industrial solutions, all running through Tuya's platform. This isn't consumer hype tech. This is back-end plumbing. That's why it feels boring. And that's exactly why it matters. Financially, Tuya generates revenue through platform services, cloud subscriptions, and value-added software layers. According to data pulled straight from Yahoo Finance and Seeking Alpha, gross margins have consistently hovered in the mid-40% range. Strong for an infrastructure-style business. Annual revenue has stabilized around $250 million, but the real shift is happening on the cost side. Operating expenses have come down meaningfully over the last few quarters. Adjusted EBITDA is moving toward breakeven. Cash burn has slowed sharply. And the balance sheet? Loaded. Tuya holds $100 million plus in cash and equivalents, with minimal debt, a fact highlighted repeatedly in Seeking Alpha deep dives and Bloomberg company snapshots. That creates runway. That creates flexibility. That creates optionality. When you compare this to peers trading at higher multiples with weaker balance sheets, the disconnect becomes obvious. Big cloud names like AWS, Microsoft Azure, and Google Cloud touch adjacent layers. But Tuya owns the device-side integration layer. That gives it real street cred inside IoT ecosystems, something industry analysts frequently point out on Bloomberg Intelligence notes. This isn't about explosive growth next quarter. It's about operating leverage, turning on slowly. Then, all at once. Imagine a simple scenario. $200 per month invested over 4 to 5 years. Roughly $9,600 to $12,000 total. And if execution delivers a theoretical 2 times to 3 times outcome, the math starts to speak for itself without needing hero assumptions. Before we move on to the catalysts, if you're enjoying this breakdown, I'd really appreciate it if you could subscribe. A quick subscribe would honestly mean a lot. Now let's talk catalysts, because catalysts move valuation. First, enterprise expansion. Tuya is moving up market, landing larger clients with recurring platform revenue. One enterprise contract doesn't create hype, it creates durability. Second, cost efficiency. Management has been crystal clear on operating discipline, something emphasized in recent earnings calls covered by Yahoo Finance. Every 1% improvement in margin flows straight to EBITDA. That's real cheddar, not accounting noise. Third, AI integration. Tuya is embedding AI into device management, automation, and energy optimization. This improves pricing power without massive capital spending. On the industry side, smart device penetration keeps expanding globally. Energy efficiency regulations in the US and Europe continue to support connected infrastructure, trends frequently highlighted in MarketWatch and Bloomberg macro coverage. This isn't optional adoption, it's structural. Financially, the biggest unlock is free cash flow breakeven. Once that happens, valuation frameworks change, multiples expand, institutions revisit the name. Bloomberg data shows institutional ownership remains relatively low. That matters. Low ownership plus improving fundamentals equals optionality. That's how re-ratings begin. At $2.25, Tuya's market cap sits near $600 million. Using conservative assumptions, the kind analysts model on Yahoo Finance, if revenue stabilizes near $260 million and EBITDA margins reach the mid-teens, valuation expands meaningfully. For some investors, this kind of setup fits as a 5 to 10% slice of a portfolio. Enough to matter if it works, small enough to manage risk if it doesn't. Here's the probability framework. Conservative case, $3 within 12 months, roughly 33% upside. Base case, $4, around 75% upside. Bull case, $5.50, over 140% upside. These aren't moonshots, they're execution-based scenarios. Right now, Tuya trades near 2 times revenue. Peers trade higher, often with weaker margins. If EBITDA turns positive and scales toward $40 million over time, even modest multiples imply serious upside. That's not wild speculation. That's math. Operating leverage is the lever. Revenue growth plus fixed cost discipline equals margin expansion. Margin expansion drives valuation faster than revenue growth alone. There's also multi-year optionality if Tuya becomes the default operating system for connected devices. That upside isn't priced in. This is how stock growth can quietly influence long-term wealth over time. The risk-reward profile is asymmetric. Downside is cushioned by cash. Upside is driven by execution, defined risk, open-ended reward. Big outcomes usually come from calculated risk, not blind bets. Risks exist. Execution risk is real. Enterprise sales cycles take time. Competition is intense. Short-term volatility can get wild. But the balance sheet buys patience. Cost discipline limits downside. This isn't a gamble. It's a measured bet. Most investors overlook stocks like this because they're not exciting. No flashy consumer brand. No headline-driven FOMO rally. Historically, infrastructure platforms re-rate quietly. Then suddenly, by the time it feels obvious, the bag-secured moment is gone. Smart money positions early, crowds arrive late. This is about trusting data over dopamine. So let's recap. Tuya offers a platform business with real revenue, strong gross margins, and a solid cash position, verified across Yahoo Finance, Bloomberg, and Seeking Alpha. Catalysts include enterprise expansion, AI integration, and margin inflection. Valuation remains compressed relative to execution potential. Price targets range from $3 to $5.50, based on realistic scenarios. Probabilities, not promises. If this breakdown added value, like the video, subscribe, and drop a comment below. And feel free to share this with family or friends who are trying to think more clearly about long-term investing. Tell me, is Tuya on your watch list, or are you staying patient? Next episode, we'll break down another overlooked growth name before the crowd wakes up. So ask yourself this: are you chasing what's loud, or positioning early before the big energy shift hits?